Hi, hello everyone, and welcome to CITEC. In this video, I'm gonna be creating a solid portfolio for 2023 with some of the ideas and vision for this year. We're gonna be investing $200,000. That is what we have available here. And we would start by selecting a solid asset allocation for this year. So for me, I would start by selecting the equities preferences. For that, I'll create a portfolio that is basically composed of US equities large cap. I am more confident that large cap it's gonna perform better in this year, especially if we get into a downturn. I'm gonna keep it to a 20%. Secondly, I'll like to have a little bit of exposure to Europe. I know things are not going great, and currently Europe is going under a lot of pressure and a lot of uncertainty, and it's not very well positioned. So for that, I'm gonna keep it actually low. I'll keep it to a 5%. Then I like to have a little bit of exposure to emerging markets. Although they have been underperforming for the last few years, I think there's an opportunity here for the next year. And additionally to that, I will have a little bit of extra exposure to Asia Pacific. That is a region that has been suffering a lot, but I believe it could be performing well in the next couple of years. So with that, I'll select Pacific, and I'm gonna be putting another 10% to that. I'm actually gonna be reducing emerging market to a 7%, and I like to increase US equities large cap to a 30%, or keep this to a 5%. With this, we'll have 40%, 50% in equities, and now we're gonna be selecting treasuries. For that, I'll do an intermediate term. I'll be assigning a 10%. And to long-term treasuries, I believe, especially if we get into recession, I believe that there's an upside here. So I'll put a 25% to long-term treasuries. I like to invest in investment grade bonds. I also think they have suffered a lot during the last year with the interest rates going up, and I think there's an opportunity here. So I'm gonna be assigning a 10% there, and I want to keep an investment in gold. And I generally put that on my portfolios, especially I think it's having a little bit of exposure to commodities. It could be a good thing. So with that, we get into 100%. Might make some adjustments here, might reduce a little bit my investment in investment grade bonds, and increase a little bit my investment in gold. With that, let me think if I want to have a little bit of exposure to commodities. So maybe I take a little bit off my equities, so 25% and a 5% on commodities, just to protect ourselves against inflation. And with this, I have a solid asset allocation. Let's say that we're gonna be investing the $200,000 that we set here, and let's have a look at how this portfolio looks. Okay, so with this, these are the ETFs we are selecting to implement this strategy. We're gonna look at an overview. We have an expected returns of 7%, a risk of a 10%. We can see that we have a 40% exposure to fixed income, 45% to equities, 15% to commodities. When I go and look at the efficiency frontier, I can see that my portfolio is fairly close to the efficient frontier. So for the level of risk that I established, and it's on a 10% volatility, is fairly close. And then I can go and see how does the back test look like. So I'll click on the back test and see that this portfolio would have performed really well during the first decade of 2007 into 2015. Then there was a rally in US equities that I didn't capture, but this really protected me against market downturns. I still feel that there's a lot of uncertainty in the market for 2023, and I want to be protected. I don't see any huge rally in the market, so that's why I feel comfortable with this strategy. So basically now what I'm going to do is that the US equities part, right, this $50,000, I'm going to delete it. I don't want to create my own portfolio of US stocks large cap versus investing here. So I'll be deleting that, and I'll be sending these positions to the trader to execute these trades later. Now what it's doing is calculating the number of stocks to implement this strategy. With that, we said that we had $50,000 to invest in US equities. I'm going to split that money in two. So I'm going to be investing $25,000 in a portfolio that it's going to replicate the performance of the index. So I'm going to be doing a direct indexing and just replicating the performance of the index. So with that, I'll run the optimization. And this is going to give me a universe of stocks and weights that help me replicate the performance of the index with 30 stocks. That's because I'm not adding a lot of money. So with $25,000, this is probably close to the best that we can do. Still like a really good portfolio to replicate the index. We can see that we have a tracking error of 1.58 with this strategy. I can go and see on the back test that in the last 6 months, this portfolio is extremely efficient to actually track the performance of the index. So with that, I'll be sending these 30 stocks to the trader. And now it's basically getting the current market prices and estimating the number of stocks I need for each individual position to replicate this strategy. So with this, I'm then going to be investing another $25,000 in a strategy that is going to be a little bit more personalized. So it's still going to be in the S&P 500, but in this case, I'm going to be doing a little bit of customization. I'm actually going to go for companies with a really high quality, and even a little bit more. And I want companies that have low volatility and they have a little bit more on the value side of things. So with that, we get into to a price per earnings of 12, 53 stocks. I may add that I want companies with liquidity, and with that I get a portfolio of 47 stocks that it's around something that is reasonable for me, and it has a high dividend yield. That is also something that I'm looking for, a 3.8. So with this universe of 47 stocks, I'm going to be using a risk parity to assign the same, assigning more money to the stocks that are less volatile. So basically it's allocating the same unit of risk to each of the stocks in that universe of 47 stocks. Let's wait. So with this, we get the portfolio of 47, and it's allocating the capital based on that. So probably allocating more capital to those companies that are less volatile. And with this, we can go and see what is the sector composition. You can see that I have a volatility lower than the market, and I can see in the backtest that this portfolio would have outperformed the market by a lot during the last year, and I believe it's gonna keep on doing so. So with that, I'll be sending these positions to the trader to get a total of I think it's gonna get to 800 and something, right? Positions or close to that. Let's wait a little bit. Okay. Now it takes a little bit of time because it's getting the current market data information. With that, we get in this beautiful portfolio that has 82 positions, and we're gonna be investing the $200,000 that we said, close to that, and we're gonna be executing these trades. So just click on execute trades, and we're gonna be saying yes. And with this, we are executing all the 82 trades with just one click. So let's wait. Now the system is connecting to our broker. In this case, we are using Alpaca. And in a matter of seconds, we will have the entire portfolio created. Voila. Let's wait. Okay. Okay, has confirmed that it has made actually 81 out of 82 trades. So we will need to look at what is the trade that it couldn't do. With that, we're gonna be closing this. We're gonna be refreshing the system to make sure that all these trades have been executed, and here they are. All the US equities portfolio that we just created, plus the ETFs that are implementing the asset allocation strategy. I hope you liked it. This is our strategy for 2023. Let's see how it performs. Looking forward to keep on talking to you. Goodbye.